the benefits of equipment leasing. Equipment leasing preserves a company's credit lines and credit facilities. This means that a company does not have to dip into its lines of credit, or more commonly known as LOCs, to acquire new equipment and/or equipment upgrades. It saves those facilities for times of emergency or when immediate cash is needed most. Also, lines of credit are not designed for long-term purchases. Equipment leasing protects a company's assets and net worth. By utilizing the versatility of equipment leasing, a company does not have to go to conventional money sources to borrow money, thus lowering its borrowing capacity and therefore diminishing its equity position and, most of all, its net worth. When a company borrows through conventional means, the newly acquired debt directly impacts the equity and net worth on the balance sheet. The higher the long-term debt, the less the strength to borrow. Equipment leasing allows the company to go outside the normal avenues of obtaining money, therefore not impacting the company's overall balance sheet strength. Equipment leasing enhances cash flow. Utilizing equipment leasing, a company does not have to put out very much capital to acquire new equipment. Yet that equipment will immediately generate additional revenue to the current revenue stream. Therefore, cash flow is enhanced and gives the company the ability to grow into new markets. Equipment leasing allows for credit diversification. Most business owners are not financing experts, so they do not look outside the conventional norms to borrow money. Leasing changes this. By utilizing non-conventional sources, equipment leasing now lets a company diversify its credit and borrowing capabilities. Through equipment leasing, a company will not be tied down by their primary money source once they have reached their borrowing limits. This diversification allows a company to spread its debt obligations evenly, therefore never being obligated and controlled by one specific lending or money entity. Equipment leasing reduces a company's tax liability. Through equipment leasing, a company can now shelter income by lowering its tax obligations with off-balance sheet finance and/or tax leases. By lowering a company's tax obligation, increases the overall net income of that company and, most importantly, the company's net worth. Equipment leasing protects a company from equipment obsolescence. This means that through leasing, a company can maintain its competitive edge. It allows a company the ability to upgrade its current equipment to the latest state-of-the-art equipment to keep up with ever-present changes and demands without a big capital outlay. In some industries, such as medical and high-tech, the ability to maintain that state-of-the-art edge on equipment is critical for long-term survival. Equipment leasing is also very, very flexible. It can be structured to fit and meet any company's business requirements. Leases can be structured with equal monthly payments for a specific term. They can be structured to reflect the company's peak earning months. For example, seasonal industries such as farming and recreational resorts can benefit from this structure. These types of leases would have skip payments. Skip payments means that when the business is in its low revenue period, meaning off season, there are no lease payments due. Leases can also have step-up payments. Step-up payments mean that when equipment is being installed and phased in over a specific time period, the lease payments will start at a lower dollar amount and then incrementally increase during installation until complete. At that time, the balance of the lease payments will be equal and will reflect the initial low start payment amount. Overall, almost any type of lease structure can be accommodated for a company's needs.